trillion-dollar wipeout, the AI crash that exposed Wall Street's biggest lie. The day the market blinked, something just happened in the markets that most people will only understand months from now. Trillions of dollars didn't slowly rotate out of tech. They vanished. Software stocks, the very companies Wall Street told you were the future of everything, were suddenly dumped. Not because of war, not because of interest rates, not because of inflation, but because of fear. Fear of artificial intelligence, fear of earnings collapse, fear that the AI boom was built on expectations, not reality. And when expectations collapse, so does everything built on top of them. The headlines say, trillion-dollar wipeout. Investors dump software stocks as AI fears erupt. But this is not just about software stocks. This is about the end of easy money, the bursting of the AI hype bubble, the silent shift of smart money. And what comes next for your savings, your pension, and your future purchasing power. Because when the market wipes out trillions in hours, it's not a correction. It's a warning shot. This is not financial advice. This is financial reality. Let's begin. What actually happened? The trillion-dollar shock. In a single violent move, markets erased over $1 trillion in market value from software and tech stocks, not small companies, not obscure startups. We're talking about cloud giants, AI infrastructure firms, software platforms embedded in governments, banks, hospitals, and global corporations. These companies were priced as if growth would be infinite, AI would print profits, and the future was already guaranteed. But then something cracked. Earnings guidance started to soften, margins came under pressure, AI spending started to look expensive instead of revolutionary, and suddenly investors asked the forbidden question. What if this AI boom isn't profitable yet? That's when the exits got crowded, and when everyone runs for the door at the same time, there is no door. There is only panic. The AI bubble. Nobody wanted to admit existed. Let's say something uncomfortable. AI is real. AI is powerful. AI is transformative. But AI stocks were priced like magic. Wall Street sold a fantasy. Every company becomes an AI company. Every AI product explodes in revenue. Every software platform becomes indispensable. Every valuation becomes justified. But reality doesn't move in straight lines. AI is expensive to run, expensive to scale, energy intensive, hardware dependent, and profit light in early phases. Most AI products today burn cash, offer free services, cannibalize existing revenue, or replace lower margin products with higher costs. So what happens when investors realize that AI hype AI profits? The multiple collapses, and when multiples collapse, stocks don't fall, they fall fast. This isn't about tech, it's about liquidity. Here's what the media won't say. This crash isn't about AI, it's about liquidity. For years, markets were addicted to cheap money, endless stimulus, central bank backstops, and the illusion that risk didn't matter. When liquidity dries up, speculation dies first. Growth stocks fall first. Hype assets collapse. First, AI stocks were the most crowded trade in the world. Everyone owned them. Everyone believed in them. Everyone was overexposed to them. That's why when selling starts, there is no buyer. The smart money already left weeks ago. The public always sells last. The same pattern as every bubble in history. This pattern is ancient. Tulips, .com, housing, cryptomanias, SPACs, NFTs, now AI stocks. Step 1, revolutionary technology. Step 2, narrative explosion. Step 3, easy money fuels speculation. Step 4, valuations detach from reality. Step 5, small cracks appear. Step 6, big money exits quietly. Step 7, retail gets trapped. Step 8, the headline screams, unexpected crash. This was not unexpected. It was unavoidable. The only question was timing. Why this matters to you, even if you don't own tech stocks? You might think, I don't own AI stocks, so who cares? Here's the problem. Software stocks are in pension funds, in ETFs, in index funds, in retirement portfolios, in bank investment products, in insurance company reserves. When tech collapses, it drags. The S&P 500, the NASDAQ, global equity funds, pension valuations, 401k equivalents, and sovereign investment portfolios. This is how paper wealth disappears without anyone noticing until it's too late. Your money is exposed whether you bought tech stocks or not. Why banks and funds are quietly de-risking. Behind the scenes, institutions are reducing tech exposure, increasing cash buffers, moving into defensive assets, hedging volatility, preparing for earnings compression, and quietly rotating into real assets. They are not screaming on Twitter. They are not doing interviews. They are repositioning silently. Because institutions move before headlines. The headlines come after the move is done. What comes next? The contagion phase. When trillion-dollar wipeouts begin, they rarely stop at one sector. The contagion pattern looks like this. 1. Tech and software fall. 2. ETFs are forced to rebalance. 3. Index funds sell everything. 4. Hedge funds deleverage. 5. Credit tightens. 6. Small caps collapse. 7. Consumer confidence drops. 8. Spending slows. 9. Earnings fall. 10. The recession narrative appears. Markets don't crash in isolation. They crash in waves. The hidden story. Why AI fear is really a trust crisis. The real fear is not AI. The fear is, can growth continue without free money? Can valuations survive reality? Can earnings justify expectations? Can the system function without constant stimulus? This is a trust crisis. Trust in valuations, trust in growth, trust in narratives, trust in the future, and when trust cracks, money runs for safety. Where the smart money is moving. Historically, during moments like this, big money moves into hard assets, defensive sectors, energy, commodities, cash, precious metals, low-debt companies, high cash flow businesses. They move away from hype, leverage, story stocks, infinite growth narratives. This time is different assets. Not because tech is dead, but because bubbles always deflate before fundamentals rebuild. What this means for the next 12-24 months. Expect more volatility, sudden crashes, relief rallies that trap buyers, earnings disappointments, political pressure, calls for stimulus, blame games, regulatory overreach, and more unexpected headlines. This is how market cycles unwind, not with one crash, but with psychological exhaustion. This was a warning shot. This trillion-dollar wipeout was not the end. It was the beginning of the market admitting something. The future was priced too perfectly, and reality just showed up. If you understand this moment, you'll be positioned ahead of the crowd. If you ignore it, you'll be exit liquidity for those who didn't. This is not fear-mongering. This is pattern recognition. Stay awake, stay liquid, stay informed, because the next phase of this cycle won't be gentle. This is Felix. See you next time.